Pratip, hi, good to have you with us. How have you been?
Great. It's been great speaking with you, Ashu. Right? It's a pleasure speaking with Asia Tech Journal, and happy to share my thoughts on some of the topics that you have up for discussion.
Interesting. I've been looking forward to this discussion. It's always good to have an investor on the other side of the conversation, right? And that's largely because we've been a capital-starved country. We have the beauty of India is Bharat in general, I think is a massive aspiration that we have, right? I think everybody wants to sort of cut that, and move into the creating something, right? I think that's so we are a creators economy in many ways, right? Be it original thinkers, be it cut, copy, paste. I think there are that's a segment which is up for debate, right? But I think that aspiration is very, very important, right? Capital becomes a very important commodity and an ingredient, right, for that kind of growth. Venture capital ecosystem has done phenomenally well, right? We've seen fledgling amount of confidence, inflow of capital, appetite to absorb risk in the recent times, right? I think it's kind of resurrects the belief in what this market can offer, right, from a consumption standpoint. And I think that's essentially what everybody kind of focusing on, right? With that, it becomes an interesting conversation in that context. But before we do that, Pratip, a quick round of a background will be a great starting point, and we dive into talking more about Inflexor, the fund thesis, and many other things, right? But a quick round of introduction will be very helpful.
So, thanks, Ashu. I'm Pratip. I've been on the investing side for the last 18, 19 years, right? Way back since 2006, right? I started my journey, working with Infosys during the .com bubble days, and thereafter went on to do my MBA from MIT, and then I used to work with the investment banking team of State Bank of India, right? So used to mostly work on capital market transactions, large scale capital raise, and focusing on logistics, telecommunication, right, healthcare. Thereafter, used to work for an Australian private equity firm called Babcock & Brown, looking at their Asia investments. Post GFC, we had to wind down a fund at that point of time, and I was doing a bit of entrepreneurial stint, trying to put together some business in the renewable energy space way back in 2008. And thereafter, I ended up joining IDFC Alternatives, which is the private equity arm of IDFC. Was part of their $1 billion fund. Again, looking at investing in growth stage equity capital, ownership anywhere between 26 to 100% buyouts. And again, in the space of logistics, healthcare, telecommunication, and energy storage. And as luck would have it, moved on to the early stage technology investing side almost 6 years back, right? As part of our Fund 1, with Jatin and Venkat, we were at that point of time, I interacted with them, worked with them, where IDFC was one of the LPs and an investor in the Fund 1, right? So that's how, if you have to say, I moved on to the dark side.
Well, not really. I think it's a very interesting point, right? Of course, a lot of people who think of investors, find it easy, right? Of what investors do. Trust me, I've been on that side of things. And especially how the markets have behaved in the last couple of years, I think it's become just so difficult, right? I think nobody can even fathom the complexity that you have to deal with, right? And I think the responsibility with which you have to sort of handle the money of these LPs, I think is so complicated, right? At many levels. But I think that's a conversation for a different time. Conversation.
Sure. I fully agree with you, because the formative years of my career gave me the perspective and the understanding on the fiduciary role when you manage third-party institutional capital, global investors, and that I think in my current entrepreneurial stint is helping me, in scaling up our platform at this point of time, along with my partners.
Interesting. I like how you're putting it as an entrepreneurial stint. I think that energy and that DNA is very critical, right? Even when you're on the other side, when you're kind of making investments, a startup is a startup, right? I think interesting. Pradeep, now Inflexor has done some amazing investments, right? I've had the opportunity of talking to a couple of your portfolio companies, right? And some of them have been exceptional, right? I don't want to take names because that'll be unfair for the ones that
Sure.
I've not spoken with, but they've been very, very impressive. I think one thing which kind of stands out in your case is very thorough entrepreneurs, right? Now, I would love to talk a little about that, but in a later part in the conversation, right? I would love you to give us a background to the fund, right? How large is the fund? What are the areas that you're looking at? What's the fund thesis? Check sizes, some of that will be really great.
Sure. So, Inflexor, we rebranded ourselves from Parampara Early Stage Opportunities Fund to be called Inflexor Technology Fund. So this is essentially our second fund. The fund or the journey started way back in 2015, was founded by Venkat Vallabhani and Jatin Desai. Right. They founded the first fund, and the Inflexor, the second fund, was started in 2020. Right. And essentially, if you see the team's background, we are a operator investor fund, right? We have, Venkat is a serial entrepreneur, having built from scratch 3 companies, scaled them, and led to strategic exits. One in the fintech, one in the health tech, and one in the energy storage side. Since early 2001 till 2010-11. Jatin has been associated with Venkat over last more than 2 decades and have been a CIO at Bank of America Merrill Lynch. So they come with huge experience in terms of execution, scale, right? From both 0 to 1 and 1 to 10. I come with an investing background of almost 2 decades, having seen growth stage capital and scaling companies in a different phase of life, right? Mm-hmm. So that's how we are an operator investor fund, and we have been on both sides of the table,
right?
and it's not we have been on the both sides of the table once, but we have been on the both sides of the table at least 5-6 times. As an entrepreneur as well as an investor. So done the journey, built it from scratch, scaled it, and then exited, right? So that's the DNA of the team per se.
That's very interesting.
And one of the key areas, if I have to say, as a North Star, that we focus when we engage with entrepreneurs, founders. There are a bunch of so smart people all around the country, right? And they're all trying to solve difficult problems. One thing that as a North Star that we focus on essentially is, has the founding team seen bad times?
Right.
And are they capable of working in a resource constraint framework and an environment?
Very interesting.
Because you take any scaled large companies today, they haven't actually required large amount of capital to begin with and to scale. Eventually, they ended up raising large capital for different strategic reasons.
Right.
So that's kind of our North Star for sure. Okay, as a team, can you work in a resource-starved environment?
Right.
Because innovation, IP, your ability to hustle takes you a longer way than anything else, right? And given that we have been through that journey, we understand and know that, right? So that becomes a very critical element, and that is pervasive, irrespective of capital cycles. Having seen the .com bust, the 2006-8 global financial crisis, Lehman, then thereafter 2014, and then the pandemic, and so these waves keep on coming and going, but these are some of the characteristics which will help an entrepreneur and a startup for a long period of time, the ability to work in a resource constrained fashion.
Interesting. Pratip, I like how measured you are, right, when it comes to say usage of capital, right? And I think you're not just alluding to the founder and the character of the founder. I think you're really sort of commenting on how the business is structured, right? The foundational framework of the business, right? And I think that's very, very critical, right? And that's, I think, a very common between a PE and a VC, right? Somebody who's been a PE and transitioned into being a VC, that's just so pertinent, right? Unlike many other VCs who raise money in the global markets, right, where they're solving for money, I think they're changing habits and all that, right? I think you're playing a very different kind of a game, which is possibly I think the strategy is very, very different, right? Identifying those premises and and looking at companies that can very quickly go and fill those existing gaps, right? Not necessarily focusing on changing the course of action largely, right? Which is going to be very capital guzzling initially, a lot of incentivization that needs to happen and all that, right? I think this is possibly very, very different in many ways. I think that's something which is visible, right? In what you kind of put out, right?
Yeah, that's broadly right, correct. And our focus of the fund per se, for sure, is in IP, innovation, enterprise, and we call ourselves as well a deep impact fund, right? When and our definition of deep impact is technology and innovation which can make a non-linear difference to the outcome.
Interesting.
And each of the investments that we end up making, going in our understanding and our conviction is in each of those places, the delta that can happen is actually 100x or maybe more, right? From what now it could be new technologies, as you said,
right,
or it could be established platforms technology which can be changed in a certain form and manner,
right?
For sure. So that's the broad overarching theme.
I think, well, you're not saying it, right? But I think market maturity also is something which is very critical in this case, right? There has to be an existing cause which one is sort of solving. I think that just helps.
True.
Possibly, when we talk about the foundational framework, when we talk about efficiency of capital, right? I think that becomes critical, right? Then the definition of the audience, right? Is it measurable? Is it not measurable, right? I think that really sort of is a fundamental difference, right, between how some of the other VCs are going to operate and how possibly you are your thesis is, right? Now, Pratip, I'm going to take a step back, right? Now you've been in the private equity side of things, and now you're in the venture capital side of things. I mean, you've been in it for 6 years, right? Of course, a lot of what you're saying is visible, right, in the thesis of the fund, right? But one thing that I want to discuss, right, is that when you're operating as a PE, you look at the country in a very, very different way, right? Now, India 2020, post 2020 is gone through a very, very different kind of transition, right? We've become information first, right? So possibly a lot of what we saw, say 13, 14, 15, 16, right? Even till about 17, 18. We've just changed all of a sudden, right? India has become this very new economy, which is very information first, at least in urban areas, right? Where the arbitrage is kind of going down between, how cities are operating, right? Which essentially means that the opportunities are going to open up much faster. The crevices that exist, which you're possibly looking to deploy capital, that transition that you're trying to sort of fund with superior applications, right? A lot of that is going to move very, very fast, right? In certain cases, might just, completely jump and bypass that entire phase, right? There could be other applications, because of the consumer behavior, which will possibly, suit the requirement of this evolution that we've gone through, right? Of sorts, right? What are your thoughts about that? What are some of the spaces that have opened up? And I'd love you to identify a couple of, portfolio companies possibly that you've invested in, right? Because of this trend shift that we've seen post 2020. I'd love you to give us a sense of that.
Sure. So, just to set the context, whether somebody is doing PE, VC, right? The fundamentals still remain the same. Everybody is a capitalist and wants to make the maximum amount of capital. Let's not beat around the bush about it. Right? Having said that, having a good set of founder or a founding team, large market, sustainable business model are key. Whether it is early stage or PE. The only difference that comes between a PE and a VC per se is on the PE, you are more about how do you manage your downside. On the VC side, your downside is 1x. I mean, you will at best lose your capital.
Sure.
But can you identify opportunities which can give you a 30, 40, 50, 100, 200x?
Interesting.
Right. It's about that, because for the losses and the hits that you take on the venture side, you need those kind of outcomes to cover for those losses. Right. Having said that, there have been number of spaces and areas or sectors per se, as you were asking, where there are tons of opportunities available to make a huge difference, right? And just before the call, we were chatting, insurance, right, or insurtech as a thesis, as a platform. India is one of the largest, market in the world as on date. It's not future, as on date.
Sure.
it's heavily underpenetrated.
Correct.
Right. Insurance is where, if you have to see a life cycle, is where microfinance was 2 decades back. When say Bandhan, SKS Microfinance started in early 2000. Right. And again, the entire regulatory tailwinds in terms of opening up the sector has gradually happened over the last 2 decades. So now is the time where it will be an inflection point of technology reducing the cost of delivery, technology playing or data playing an immense role in underwriting and scaling up, and then adoption in terms of people becoming more aware of the need, whether it is on health insurance because of say COVID and all those things, or motor insurance, where there are a number of regulatory frameworks in the last 2 years the government of India has passed to make those penetration successful, right?
Interesting.
So that particular space, as you said, it was always existed. It has always, and till today also it is existing for the PE side as well as for the VC side, because the market itself is very large. One needs to use technology as a backbone, as a horizontal, play tool to see how the scaling up takes place and the cost of delivery goes on. So that's one sector, one space per se, right?
Interesting.
The second space and the second area that I would like to put emphasis is the entire supply chain, the entire supply chain and the logistics space, right? Where supply chain is essentially the movement of goods, money, right, and information. Right. Now, how do you create efficiency which can help in your overall country's GDP growth? Now, whether it is export-import or on the domestic side, there are huge low-hanging fruits where technology can actually act as a great leveler and improve competitiveness in a much more bigger globalized world per se, right? And so, say on the insurance tech space, we have invested in Gramcover, which is a non-urban insurance distribution platform.
Interesting.
Which has aspirations to become eventually a manufacturer.
Very interesting.
We have invested in the logistic tech space on the Exim side with Kale Logistics, which is focusing on improving cargo flow through ports and airports. And again, the application of those technology, cloud-based software products have a global use case, not just in India, but even overseas. The third area is this field of cybersecurity, which we had only briefly touched upon. And we have recently invested in a company called Secure Things, which is a software product play focusing on in the automobile space, because today a car is equivalent to a computer, right? With all the gadgets and the upgrades happening over there, and it is hugely prone to hacking. So it's an evolving field, and Secure Things is doing some exceptional work with some top-notch OEMs in this area, because again, as I said, the overall theme is it needs to create a deeper impact. That's what deep tech is all about.
Interesting.
If a technology is always in R&D with back-ended or 10 years later impact, people will not be able to get the benefit in the next few years, right? So how do we pick and choose areas, spaces, companies wherein not only technology is the backbone, but can also create as I said, much bigger delta in terms of an outcome? And that's where the non-linearity of the venture capital comes into the play, because these are evolving areas and spaces.
Interesting. Now, Pratip, some very interesting points that you kind of highlighted, right? Very important and pertinent points as well. Now there's a shift, right? And I would like to pick up, say, for example, general insurance, right? Now, I think one thing that we're seeing, right, is that, with many of these insurtech companies that have come up, right, they're not essentially going down the traditional route, right? While, of course, there's under-penetration, the larger numbers are the way they are, right? And all of us know about all of those numbers and the opportunity that exists, right? The insurtech companies are looking at a completely new distribution channel, right? Embedded insurance, for example, is picked up, right? Especially in a market like India, which is working on a very low savings rate, it becomes important that you have, fragmented insurance which is plugged into a variety of products that you could be consuming, and that makes coverage easy, efficient, and you can really sort of cost of distribution comes down, right? Which is a very critical component in the larger scheme, right? Now, in a game like this, right? I mean, there are a bunch of players that are already there, right? I mean, there is Simbo, which is doing great work. There is Toffee, right? There are quite a few players that have come in the embedded insurance space, right? Especially general insurance, because that's just so much more critical, right? I think life continues to still deal with certain baggages and preconceived, notions, right? India is a large complex market. Now, in an environment like this, right, when you're building for a market which is as large as India's, capital becomes very, very critical, right? Speed of capital becomes equally critical. What we've seen, especially in the last 2 years, is that, and I think, because there's a certain homogeneous trend that is coming in, and our consumption as a country is now becoming predictable. CACs have become now clear, right? And that's the reason we're seeing the kind of influx of capital that we are. What do you make out of a situation like this, right? Where, like I said, the requirement of capital is going to be so much more faster. There are distribution systems that already exist. The newer layers are actually riding on top of them, where the visibility of the customer is just so much more superior, right? Two things. One, what happens in an event of excessive liquidity, which is what we're facing right now. And second, the requirement of continuous capital is going to be very, very high, right? We're seeing some very solid second rounds that are happening, right? At a series A level, series B level, right?
Sure.
The company would have gone on to raise, say, $2, $3, $4 million, $5 million, and the next round that we see is $35, $40 million, right? Now that's a substantial jump, and that's largely possible because of the visibility in the consumer, this thing, right? Now, for a fund like Inflexor, how are you, like I said, right? How are you looking at entry, and how are you looking at layering it up in the second round? Some of the other funds that are there are adequately capitalized, right, to sort of be largely participating in the second rounds, right? What's your sense of this complexity which is emerged from a fund side, especially the last 2 years?
So, yes, you are right. Round sizes have gone up, right?
Sure.
So, check sizes needs to be appropriately distributed. And what has this led to is to see if there are funds with similar thesis and thought process. Sure. They form part of a club, and you do the initial checks, right? And so that's how the initial rounds are getting structured. Most of the rounds that you are reading today in the papers and in and around, right, you will very few you will find is, okay, ABC fund is the only investor who has invested in that company.
Sure.
Right. So the problem is not just with a fund or a smaller fund. Irrespective of check sizes, it is across the board.
Right.
Whether it's a smaller fund or a larger fund.
Right.
So the problem. So it's important to figure out who could be the right play or the partners or other fund, like-minded fund, and it varies from opportunities to opportunities. And you work with them to structure a transaction, right? That's part A of your question.
Sure.
On part B, where follow-on rounds are becoming larger, right? There we obviously have our pro rata rights to invest to the extent possible.
Sure.
And in addition to that, we have some deep pocketed institutional as well as non-institutional LPs who have invested with us,
sure,
right? And we co-invest alongside them in structuring those larger rounds, right?
Right.
And in a way that also gives them a larger amount of capital to deploy in an area or in a company where the fund is already invested. So which gives them better comfort on governance, on processes. Right. They get visibility into past performance, and they need not at that point of time do a separate diligence process. Right. And they can completely rely on the GP or an asset manager like us in order to make those transactions happen.
Very interesting.
But having said that, you need to also ensure those things work from a founder perspective.
Right.
And for the founder, it's getting a bigger institutional name alongside a fund, which, in a market like insurance or any product in the field of finance, it adds to the credibility and the trust factor.
Right.
Because in the end, if you go to a retail consumer to sell your product eventually.
Sure.
I mean, as a brand, they may not know Inflexor.
That legacy becomes important.
But they might know, okay, yes, SBI is there, or SDFC is there, or someone is there, right? Because they relate over a period of time with that.
Absolutely.
Right? And that helps even for the startup as well as for the entrepreneur. Right.
Interesting.
And that helps, right, broadly. And that's how we are doing things. And we are looking at, looking at the entire space of investing.
Wonderful. Pratip, how important does speed become, right, in the entire scheme of things? I think we've seen some phenomenal speed, right? How important has that become, right? I mean, when I read of this, right, as a media organization, we talk to many investors, right? We cover a lot of this stuff, right? A lot of this seems as if there's this rush, right? There's like a pre-booking which is happening. You've got your first check and you already decided that this is possibly these are the indicators. A month down the line, possibly 2 months down the line, if they start to sort of have a thesis, right, that you're investing for against, right, and as soon as that starts to play right, in certain probabilities, right, you're immediately ready to cut the next check, right? What's your sense of this entire, say for example, the shift and the speed that has come into investing? What do you make out of it, right? Good for the ecosystem, bad for the ecosystem. Valuations, again, for example, have become very, very expensive, right? For anybody who's largely raised capital in India, I've had a couple of other interactions, right, where the fund managers have, in a certain form and way, not really directly, right, but highlighted that there's a lot of bizarreness in what's happening in the market, right? It needs to rationalize because while of course we've become one large ecosystem, arbitrage is kind of reducing, the certain predictability is coming in. We still are a country with many sets and subsets, right? We still have cultural gaps. Not say a north market looks like a south market or an east market looks like a west market, right? That still is gonna be it's still required for businesses to calibrate and recalibrate, right, depending on where they're kind of expanding, right? What's your sense of it? What do you make out of this entire event of stretched valuations and the speed with which all of this is happening?
So two things on speed. I wouldn't call it speed. It's more of a momentum, and it's more of cyclicality, right? And we have seen many such cycles, right? And they can be for an elongated period of time, and that's where the job of a GP becomes much more challenging, right? So the way we look at it from a speed or a momentum perspective, it's about having deep conviction, but conviction also which is based on also knowing what not to do, and not be part of a FOMO or a herd mentality. Right. Because there's transactions running past all around, right? So it's more of like thinking fast, thinking slow, right? So things which we know we don't want to do, or we know, okay, look, these are the 6 gatekeeping items that we would look for in any transactions, no matter what, then it's very easy to not get swayed by the momentum and the FOMO. Having said that, if something comes up our alley which fits our scheme of things, we are there to make a decision in less than 2 weeks, right? From a speed perspective. And again, that is from a decision-making perspective. Execution still takes its own time, whether it is in the form of a diligence or some processes or regulatory paperwork. Those things are not in our control. But to a founder where he is building out a company, if our conviction is fast and we know what to do and what not to do, and we quickly in 2 weeks time tell that founder, okay, yes, we are in, this is what it is, they are pretty much assured, okay, look, once these guys have said, it's good to go. It might take time in terms of a process perspective, given that
which I think is a standard for everybody, right? I mean,
which is standard for everybody. That helps a lot. So in fact, most of as a team, from a framework perspective, we broadly know, okay, look, these are the things that we will not do no matter what. No matter if large US fund is willing to write at the same valuation as us, and you will, that doesn't sway us. We have our own gatekeeping items and our own, independent thinking. So things where we are fully convinced, we are there from a decision making. That's how we are actually looking it's not about doing more, it's about doing less. But whatever you do it much faster than your competition.
I think that's become mandatory, right? I think in a market like this.
Yeah. So it's not about doing more, it's about doing less and doing it well. And that becomes critical.
And I think possibly with all the diversity and experience that you have at a team level, right? I think that just helps you, comprehend and dissect some of these, opportunities much better, right? I think that execution side understanding is very important, right? In many cases, and I think that to me, a lot of funds, for example, when I look at, right, don't necessarily have, right? So they are professional investors who are really focused on investing. And like I said, right, there is adequate amount of capital to cover up for how things shape up in future, right? Money for course correction, right? I think here you're possibly doing it differently. Like I said, you're bringing in that execution intelligence while you're looking at companies, right? And that just is very different, or a very strong differentiation vis-a-vis many other players, right?
Absolutely, because in the end, you end up making money on execution. That's where the rubber meets the road. Right.
Interesting.
And we tell our founders, it's not a sprint, it's a marathon. You will have your peer group, people who might be raising tons of money in a very short period of time. But also you need to also be cognizant of the long term. And that is something, as I said, from a North Star perspective, becomes very important going in, to have those discussions at length with our potential partners in the form of founders.
Super. Pratip, now one question that we've discussed about 2020 and how the markets are kind of shifted. Of course, you have a thesis, I have a thesis, right? But for the best interest of a lot of people who are going to be watching this, right? I'd love you to take us through what kind of a shift that has happened, right? In a post 2020 environment. For example, so when you're looking at companies today, right? I mean, founder, for example, becomes one such thing, right? Opportunity, and the size of the market becomes another very critical piece, right? Because of the certain exit that you're looking at, right? What are some of the other matrices, operating matrices, for example, that you start to look at in a different way in a post-2020 sort of an environment? I'd love to understand that, right? For example, CACs are going through the roof right now, right? Now, how do you, for example, look at that, right? I mean, is that something which is okay? Do you think there is this momentary this is like a momentary phase? It'll all eventually settle down. How are you looking at some of these operating aspects, right? I'd love to understand that, especially, like I said, in a post-2020 environment, where the markets have become very, very transparent.
So it's very essential when you're building out a business to ensure alignment across all stakeholders.
Sure.
As long as those alignment, whether it is the employees, the customers, the shareholders, founders, if they are not aligned to a certain value proposition,
sure,
the entire house will collapse. Right. So, and that alignment, how do you build out that alignment is very critical, right? Today, technology resource is a very scarce commodity.
Right.
So-called star engineers, right?
Right.
Now, you might say, okay, I will go ahead and end up hiring somebody at a much higher salary, but then that completely disturbs the existing HR, pyramid in the organization, where people who have stayed with you will feel disgruntled, right?
Sure.
So what is more critical at this junction when you are saying CAGs are going through the roofs, or so much of capital is flowing through the system, is to ensure how do you create alignment within and all the stakeholders, and also between incoming new clients versus old clients,
right?
New employees versus earlier employees. So how do you manage your technology team again in a resource constrained fashion, but giving them adequate challenges and compensation becomes critical. So those are the areas which are now much more focus areas and people have to focus on. Because in the end, if you are competing just on the basis of capital and the salary, be rest assured there are 10 other people who can also match the salary or give a better salary.
Absolutely. Right. That cannot be a long-term differentiator.
Right. Again, from a customer's perspective also, you have acquired me for a year. Right? You have paid top dollars to acquire me.
Right.
I know what's the assurity I will continue to be on your platform for the next year. So the value proposition needs to be much more longer driven, right? And that's where those alignments come into the picture, and it is becoming more important in a post 2020 world because a lot of both clients as well as employees have gone remote.
Right.
So
that's absolutely another layer of complexity.
Correct. So those things become pretty important, right? From a metric perspective, how do you ensure? How do you manage that?
Right. Very interesting. Now, Pratip, there's another very, very important aspect, right, that I want us to talk about, right? In a conversation as deep dive as this is, I think it just becomes important, right? Now, we've continued to talk about 2020. I have across 400 conversations that I've done. I have talked about 2020 and the effects of 2020. Right? Now, what is also happening is that because of the size and shape that we are, right, which is, and we've largely been very touch and feel sort of an economy. There's this excitement, compulsion, necessity, want, desire to move back to normal, right? Which is that again the touch and feel, right? Now, a lot of funding, for example, that has happened, especially at tech for that matter, right? That has happened, digitizing of education, right? A lot of that, and once we possibly move back into the normal, right? A very small part of this shift is going to continue to happen online, right? What's your sense of it, right? I mean, you have investments in, in edtech, right? Some of the most incredible companies that are out there. And I'm personally a very big fan of practically all the good work that Charu and her team is doing. What's your sense of it? How do you sort of dissect this entire thing, right? Because, like I said, a lot of visibility is again going to get, the ecosystem is again going to become very, very opaque, right? We have many layers. We have, a lot of other regional complexities that sort of kick in, right? Infrastructure again is a very big problem, right? Digital infrastructure I'm talking about, right?
Sure.
Laptops, other things, right? Going back to normal only makes more sense, right? Plus, there is a lot of capital which is already invested in creating a lot of this, say, for example, physical infrastructure that we kind of talk of. And there is, again, also a political sort of an inclination of things getting back to normal, right? Because then employment starts to look very different. There are a variety of other things, right? And those are some very critical macro challenges that we face, right? What's your sense of it, right? How are you looking at that, say, adjustment, going back to the normal? How are you viewing that, right? Across, say, some of your portfolios, love to understand that.
No, so for sure, across the board, you've just taken one example in one sector, per se, edtech. So we keep an open mind about the evolving business model across sectors, not just edtech. But what is again important for us is how do you make it sustainable for the long term? And if you have built-in levers around that, then it becomes important. For example, if you look at Play Shifu, right? They are a AR, VR gaming edtech company, but the use cases is not just on the STEM education perspective, right? There is a wider gaming aspect of it which is there, and again they are a platform company having built out already 3 platforms. Their 4th platform on the metaverse side is currently under works. So they have been nimble enough to create incremental platforms and products targeting different use cases and different segments to continue to evolve, innovate, and ride along the curve. So that becomes very important, right? And and that's where the ingenuity of the founders come into the play, of thinking out of the box, trying to create a deeper impact, and then saying, okay, I might have a resource available, right? How do I optimize the use of this resource? And resource doesn't mean just capital, but it's also talent, technology, and the existing business. How do you make it work in a different framework for a different TG, target audience, right? So that becomes very important. And we are looking at that entire play happening. Again, in the cyber security side, also a lot of work is being done, right? And we are seeing it through Secure Things, through Data Resolve, right? Through CloudSec, right, which is a dark web monitoring company, right? So we are seeing some of those evolving business models coming up, right? That's where things are.
Pratip, how I want this conversation to go on, right? And discuss much more about some of these portfolio companies that you have, right? There's just so much of interesting stuff to know, right, and to question. Because, like I said, the markets are constantly shifting, right? The behavioral tendencies from a consumer standpoint are, continuously. I kind of put it across a lot of my conversations, right? That fads are going to fly faster, right? And I think that really becomes a play. To understand the founder's mind, and I think more importantly, to understand the nuances that you, for example, look at, right? I think it's just so intricate, right? It's so delicate at the same time. I think it's very difficult to capture it in one such session, right? We possibly going to need to have many more of them, right? Towards the end of a conversation, what are some of the exciting areas going forward that you're looking at? Because you alluded to some of them, but if you were to say, put out three that you are looking at, what would those three be?
So I would say, climate tech or resource efficiencies. We have already an investment in that space called Atomberg Technologies, which is a consumer tech, platform play on the energy efficiency side. They have a bunch of consumer tech products, ceiling fans, mixer grinders. You should look it up there. We have invested in it across two funds. So that's one area which will see a lot of action, right? And we have a deep conviction in that space. The second area is for sure will be in the area of, biotech, right? Because that's another area where a lot of work is being happening, which has the potential to create a deeper impact, right? From a long-term perspective per se, and these are all, commercialized.
And I think post-COVID, I think that's just a space which has just opened up and how, right? I think the audience has become sensitive in general.
Correct. And I would say the third area is will be the area of space tech, right, where we have an existing investment in Bellatrix Aerospace, who were recently in the news to develop, being one of the first in the world to develop a green monopropellant, which the entire fuel will become much more greener, less toxic, much cheaper. So with the entire all the rocket launches which is expected to happen by various startups and various people all around the world, so they will have an important role to play as well. So these three areas are upcoming, which we think can create a bigger and a deeper impact in the entire ecosystem per se.
Super. Pratip, last question in this conversation, in this part of our conversation. It's very cliched, but I think an important question, right? I use it for my guests to give out any advice, suggestion to the audience who's going to be watching this. I think in this case, one of the key stakeholders becomes the founders, right? We're constantly looking for capital, for growth. A lot of occasions, understanding the other side, and the other side's perspective, I think becomes just so much more important, right? We tend to look at capital in a very non-sensitive way, right? I think we tend to, as founders, prioritize our growth and many other things, right? And forget, for example, the answerability of the investors, right? It's just so much more higher, when you're dealing with somebody else's capital, right? So if you were to give any advice whatsoever, to these founders in terms of, say, which helps them improve their, the possibility of engagement or, improving their businesses, what would that be? I'd love you to use this section to do that.
I guess, we all come from an Indian middle class family, right? All across, and all founders as well, right? So one key piece of advice which always comes into play treat any money which comes your way from anyone as your parents' money.
Good one.
Right. So as long as you have that thing in the back of your head,
right,
you become much more disciplined, conscious.
Right.
And the second would be, in a world which has seen liquidity flows to a completely new levels,
right.
There are periods of time where liquidity has disappeared from the world within 3 days, and we have seen the likes of Goldman and AIG reaching out to Warren Buffett with a begging ball, right? So, so that's those things people need to
efficiency becomes important.
Yeah, keep them in mind, right?
Possibly, there is some section of the business world that continues to talk of the liquidity crunch we're possibly going to enter, right, because of the global tightening of inflows that is there. But you're absolutely right. I think I concur with a lot of points that you highlighted, right? That at a DNA level, at a foundation level, you have to be so much more optimized, right? I think you cannot really kill for and solve for with capital all the time. Especially like a market like India, right, which is just so much more complex. And we're very fragile in many ways, right? While we're a very large consumption economy, we're very fragile, right? Our tax paying base is much smaller. Our people in the formal workforce is much smaller. We still are a very entrepreneurial nation in many ways. A large part of section of society depends on that. Agriculture again becomes a very, very large part of it, right? And these are areas that come with their own inconsistencies, right? Your ability, savings, for example, again is a very, very critical indicator, right? Which is just so much more thinner, vis-a-vis other developed nations, right? Of course,
sure.
We're still a savings first country. That saves us from many of these external issues, right? But as a company, as a country, if we are to get into that territory, which sort of unleashes us from a consumption standpoint, I think we're still not there. I think a lot of work needs to essentially happen, right? And thus it becomes important that structurally you're in the right position to handle a lot of this, these aberrations that could sort of come in, right? Pratip, it was a pleasure to have you with us. Thank you so much for taking the time out. Like I said, a first conversation, not the last. Look forward to doing many, many more with you much sooner. I think a lot of points that you highlighted in the conversation were very pertinent. And like I said, right, I'd love to probe them further across some of our. Thank you so much for doing it.
Thank you, Ashu. Thank you, Asia Tech Journal, for hosting me. Thanks for your time. Have a nice day.
Have a good one.
Bye.